Hi, this is Brandon Bischoff with Canterbury Investment Management, bringing you this week's Canterbury Market Update for the week of September the 23rd, 2019. And so the current market state, when looking at the S&P 500, is market state 2, which is one of the 5 bullish market states. And so its characteristics are long-term positive, volatility is declining, and short-term supply and demand indicators are still negative. And the shift to market state 2 comes from kind of transitioning out of that transitional market state. We saw a spike in volatility back on August 5th, followed by a market pullback. And since then, the market's kind of rallied and actually flattened out, which has sent us back into market state 2 as volatility's declined. And so one thing to note about market states is they're actually a measure of risk. They are not a measure of return. So just because we're in a bullish market state does not mean that the market's about to run up substantially. What it means is that, in this case, the risk of the market is lowering, volatility is declining. And so if we look at a chart of market states historically, this chart goes back to 2000. You can see the green zones, which are bullish market states, the red zones are bearish market states, and the yellow zone are transitional market states. Well, in those yellow and red zones, the risk is typically a lot higher in the market, whereas the green zones, you see a lot more of the substantial runs. But another fact about market states is we don't know how long each market state is going to stay in place before transitioning to a new environment. So there's been many cases of transitional markets that stayed transitional for a very short period of time and went back to being bullish. There's also been some bear markets that have ended positively because volatility gets really high, but then calms down really quickly. And the case of that is December of 2018. And there's also been bull markets that have been very, very short-lived. So market states, they're not a projection of what the return is going to be. They're a measure of what the risk is right now. They're also not a measure of what the risk will be, next month or 3 months from now. Those metrics can change very quickly. And so moving on, looking at the volatility of the market, which we use measuring the Canterbury Volatility Index, it measures CVI 73. So CVI 73, we generally consider volatility levels below CVI 75 to be safe. This CVI level right now is actually at the upper end of its range compared to where it was. So when the market was at a peak and then had a volatility outlier, volatility got as high as CVI 87, but it was as low as CVI 52. So since then, volatility's come down a little bit, but it's still closer to CVI 87 than it is to CVI 52. But if we do look at short-term volatility, which is a 10-day CVI, that has declined substantially, and it's actually entered extreme low territory. And so what this means is when volatility gets extremely low, it's kind of like the market's getting a little bit complacent, and it's like squeezing down a spring. So eventually you might experience a pop or spike in volatility. And there's been many cases of this happening where you see the short-term CVI gets really low, volatility is a little bit higher, and you see, a 1% outlier day up or down to sort of end that run there. And so coupled with this transitional market state, or this bullish market state too, and declining volatility, the market is entering a point of resistance. It's kind of at that near that old high level, and since it's gotten there, it's sort of flattened out. And again, you can see in this chart that the 10-day volatility or short-term CVI has declined to an extreme low level, while the regular volatility or CVI remains kind of higher. And again, this could lead to an outlier day. Looking at the portfolio thermostat currently has a portfolio efficiency score of 90, a volatility of CVI 32, which is low, and a benefit of diversification of 56%, which for a bull market is a little bit higher. But as we're coming out of this transitional market and nearing this resistance levels, there are higher probabilities of seeing outlier days and maybe going back to retest that low. So you want to stabilize the portfolio in case any of that were to happen. But also, the portfolio thermostat holds a combination of securities exhibiting low risk, bullish, environments or characteristics that could experience substantial runs should the market kind of continue to head upward. So that brings us to the end of this week's update. I hope you have a great week.